10 things I wish I knew before I started trading options. After 20 years of trading options and learning these lessons the hard way, I've identified the 10 most important concepts that would have saved me years of frustration, costly mistakes, and unnecessary losses. This short course isn't about complex strategies or advanced techniques. It's about the fundamental truths that most traders discover only after they've already paid tuition to the market. These are the insights that separate those who survive and thrive from those who blow up their accounts. If you're just starting your options trading journey, or if you've been struggling to find consistency, these 10 keys will dramatically shorten your learning curve. Each concept addresses a critical gap in understanding that trips up nearly every new trader, from managing winners properly to grasping the counterintuitive nature of premium selling. Consider this your roadmap to avoiding the most common and expensive mistakes in options trading. Let's dive in.
Number one, managing winning trades at specific profit targets. Here's the thing that drove me crazy for years. I would put on a perfect trade, hit my 50% profit target, and then I would get greedy thinking just one more day. The next morning, I would wake up to see the trade blow up. Most gurus tell you to hold short premium trades until expiration to maximize profit, but that's dead wrong. When you manage winners early at 50% of the premium collected, you actually increase your overall expectancy. Yes, you leave money on the table sometimes, but you also avoid those gut-wrenching reversals that can wipe out weeks of gains in a single day. Number two, patience, understanding that markets move and let the math work. New traders panic the moment a trade moves against them, but here's what I wish someone had told me. Markets actually move. If you structure your trades according to probabilities with 45 to 60 days to expiration, you have to let time work in your favor. I have seen traders puke out of perfectly good trades just because they couldn't handle normal market movement. Remember, we're flipping coins here. If it comes up heads when you bet tails, you don't stop flipping coins forever. Trust the math and give it time to work.
Number three, the deltas for puts and calls at the same strike always total 1.00. This is basic options math that nobody teaches properly. At any given strike price, if the call has a delta of 0.30, the put will have a delta of 0.70. This relationship is constant, and understanding it helps you see how options pricing really works. It's not magic, it's mathematics, and this simple relationship is the foundation for understanding probability in options trading.
Number four, selling puts is bullish, selling calls is bearish. This is counterintuitive to what we think. This one messed with my head for the longest time. We're conditioned to think owning puts means you want the market down, owning calls means you want it up. But when you are selling, it's the opposite. When I sell a put, I'm collecting premium and hoping the stock stays above that strike. That's a bullish position. When I sell a call, I want the stock to stay below that strike. That's bearish. It's completely counterintuitive to everything we learn about buying, but critical to understand as a premium seller. Number five, the importance of liquidity, the bid-ask spreads, and open interest. I have had traders show me positions where they were literally the only person in the world holding that strike. They were trading against themselves. You need stocks with tight bid-ask spreads and significant open interest, or you'll get killed on entries and exits. I stick to about 200 liquid stocks that trade over 1 million shares daily with plenty of open interest at the strikes I'm targeting. Don't chase some obscure stock just because the premium looks juicy. You'll regret it when you try to exit. Number six, implied volatility rank, IVR, is more important than implied volatility alone. Here's what nobody tells you. A 30% implied volatility on one stock might be sky high, while 30% on another stock might be dirt cheap. That's why implied volatility rank matters. It tells you where current volatility sits relative to that specific stock's historical range. I only sell premium when IVR is high for that particular underlying, not just when the raw implied volatility number looks good. This single metric will save you from selling premium too cheaply and to pass on a short premium trade. It also aids in exits. Because volatility is mean reverting, it is prudent to exit short premium trades when IVR materially contracts. Number seven, You don't have to be right on direction to be profitable. This was my biggest revelation after 20 years of trading. With directional trading, you're right, maybe 50% of the time at best. Even the greatest stock pickers can't do much better. But with non directional premium selling, I can be profitable even when I'm wrong about direction. As long as the stock stays within my profit zone, depending on the strategy I selected, I win. It's not about predicting where the market goes, it's about predicting where it won't go. Number 8, the potential impact of binary events on underlying price and implied volatility. Binary events like earnings, FDA approvals, or major announcements don't just move stock prices, they cause massive volatility expansion that can destroy your position even when your short strikes are not in the money. I learned this the hard way. On occasion, I would sell a strangle. The stock would stay between my strikes, a winning trade on paper, but volatility would spike so hard that my unrealized loss would rapidly increase. This is not an unusual occurrence for short premium sellers and is something the option seller needs to fully understand. As long as the short strikes are out of the money, the trade will still be profitable at expiration, but the volatility expansion and the temporary increase in your buying power requirement will test your patience. Number 9, the distinct difference between implied volatility and historical volatility. Most traders think volatility is just volatility, but there is a crucial difference. Historical volatility tells you how much the stock or ETF actually moved in the past. Implied volatility tells you how much the market expects it to move in the future. The market consistently overestimates future volatility. This systematic overestimation creates a built-in edge for premium sellers. When you sell options, you're essentially betting that actual movement, historical volatility, will be less than what the market expects, implied volatility. As premium sellers, we target opportunities where implied volatility is elevated relative to historical volatility. When implied volatility spikes, often due to earnings announcements, market uncertainty, or news events, option premiums become artificially inflated, providing an edge for premium selling. Number 10, many traders don't realize you can sell something you don't own. This sounds obvious now, but it blew my mind when I first exposed to it. Everything in life teaches us to buy low, sell high, buy a stock, hope it goes up, sell it for more. But in options, you can sell first and buy back later. I can sell a put or call that I don't own, collect the premium immediately, and then buy it back later for less than I sold it for, or let it expire worthless. It's the complete opposite of how we think about every other asset, but it's perfectly legal and incredibly powerful when done right.